The Fed is now done, apparently maybe done with rate cuts for the rest of the year. Like it or hate it, it is what it is. What are you seeing your clients at Direxion starting to do or doing with the current Fed environment?
So actually not a whole lot different than what they were doing before the Fed announcement. So the Fed announcement was pretty interesting because if you caught the first 5 minutes of it, the market barely reacted at all. It was sort of, what was expected, and stocks held steady across the board. But, flash forward half an hour later, when we sort of dug into the commentary and it felt like more of a hawkish cut, the market started to pull back. And as you said, we had the best or sort of the worst hour or so in the past 2 months in equity markets. But, I think if we take a step back from this and we think about what it all means, why did the Fed cut 25 bips? We could have argued whether or not they should have cut at all. The consumer remains pretty strong. Spending is up about 4%. Job numbers are pretty good. The big issues in the economy are really manufacturing slowdown and trade tensions, and companies having to worry about going to China, where to manufacture, spending to get out and continue global growth, and not so much that rates are too high. So what I would say is that what we're seeing is sort of flows into the same sectors. We've seen flows into tech. We've seen flows into growth over value, cyclicals over defensives. We've seen flows into semiconductors. And, we have seen a little bit of flow into gold. Yesterday, the last hour or so would sort of negate what I'm saying. But I think if we come back to the market this morning and we look at that 2.04 number, rates are pretty low. Inflation-adjusted rates are pretty low. And, the security trade really is gold. So you have your growth, your cyclicals, no recession. You generate some alpha there, and then you sort of hedge with gold and other alternatives.
Well, if interest rates are low, it might entice people to buy things like boats and cars and, maybe even housing. And I know you guys got one of these 3 times bull ETFs. Nail, nice ticker, by the way, is a 3 times bull homebuilder ETF. It has doubled this year. Are you still seeing a lot of attention in the homebuilders?
We are, and actually one of our marketing guys came out with a great line, home builders is really nailing it right now. So love it. So, Lennar, D.R. Horton have had an epic year, up 20 to 30%. We thought that the housing market would slow down. They went into the new entry market instead of the high-end, high-priced, Hamptons mega mansion market, and really benefited from some of that. You had Masco, companies like Masco, which make up the home builders index, up, 20 to 30% off of higher sales with windows and cabinets. So, while the headwind there could be a, slowing economy, I think keeping rates low is something that might actually keep that sector propped up. And it's actually one of the top 10 performing levered and inverse ETFs year to date, along with tech, semiconductors, and gold, the last 3 I mentioned, which was actually a surprise to me. But it's the low rates are holding that sector up.
You know who does not care about the Federal Reserve or rates? Technology investors. I mean, I'm not saying that technology is immune entirely, but for the most part, Apple has no relationship to what the Federal Reserve does. The FANG stocks, probably no relationship. Are you still seeing a lot of interest in technology names, Sylvia?
Absolutely. So Apple earnings, crushed it really. So wearables were up, services are up. They have this unique client base. What was interesting, too, is also that number in China. We were sort of so worried about China growth slowdown, and they had about $9 billion in sales there. So Apple kept the tech index up. Microsoft had the sort of best first half of the year in tech ever. Oracle was up, Visa, MasterCard, Alphabet, talking about buybacks. The sector just keeps, rewarding us, really. The margins look pretty good. The growth is strong. And I think that, investors are continuing to go to stocks that have just continued to perform well over these last few months.
And no sign of lack of appetite on technology. People still buying it. They still want it.
People are still buying it. The average daily trading volume for us over the last 20 days is up 100% or more. Tech L, our 3 beta ETF, is up 120% month to date. The 1 beta index up 33% month to date. Growth over value, you've got a 7% spread. It's in the 20s this year. So I think that investors are still flocking to those names that have rewarded them. Not to say that we haven't pulled back and gotten a little defensive, but I think if you're looking for alpha, tech has still been the place to find it.